Okay. Oh, it's on. Okay. I'm Scott Foster. I'm a Securities Analyst and the S&S guy in Japan. And today it's my privilege to ask some questions of Mr. Ira Kalish, who's Director of Global Economics at Deloitte Research. And the title of the session is Finding Solutions to the Current Global Economic Challenge. So I guess the best place to start is just to ask, what's your view of the challenge? What are we facing here?
Well, we obviously face the deepest recession since the Great Depression, but I'm cautiously optimistic that we'll get out of it pretty quickly. Because after all, we haven't dropped any bombs on our factories, we haven't lost our knowledge of technology or innovation, we've simply lost confidence, and we'll get that confidence back. And we lost the confidence in part because we had too much confidence for the past decade. We had confidence that we could borrow more than we could, that we could pay it back. Our banks had confidence that they could operate with much less capital than made sense, and they had confidence that the prices of houses in the United States would rise forever. And in fairness, that was maybe a reasonable expectation because not since the Great Depression have we seen a general decline in house prices in the US. But now we're experiencing it. It's a black swan event, but it has caused us to lose confidence, and it's caused credit markets to shrivel up because banks have lost the confidence to lend to one another and lend to others. But when we get that confidence back, we'll be back on track.
You don't think that we're spending so much money trying to stabilize the system that there won't be anything left to build a future, and we might not be stuck in a hyperinflationary environment?
Well, normally it makes sense for governments to balance budgets. Normally it makes sense for central banks not to print too much money. These are not normal times. When you have a situation where the private sector is massively deleveraging, paying off debts, reducing spending, you wind up with a dramatic shrinkage in economic activity. And the only institution that has the capacity to offset that is the government by massively leveraging. And when you have a big deleveraging of the private sector, it makes sense to run very large budget deficits. And I think the best criticism of the current fiscal stimulus is that it's not big enough. If we have the private sector deleveraging to the tune of $2 trillion and we have an $800 billion stimulus, that may not be sufficient. In an ideal world, you'd want to have a very large stimulus that's temporary, but with a credible long-term plan to keep the balance in budget. Instead, what we have is a sort of moderately sized budget deficit, although it's much bigger than a lot of other countries are doing, to our credit, I think. But we don't necessarily have a credible plan to reduce the budget deficit significantly. The most successful fiscal stimulus plan ever was World War II. And it basically entailed the government spending a massive amount of money on things that are utterly useless. Weapons doesn't increase our standard of living, doesn't increase our productivity, but it put people back to work, and it did end the Great Depression. And I think it's a good thing we're increasing the amount of debt. And if we wind up, as the Obama administration plans, on ultimately having a deficit of about 3% of GDP, and if you have 3% GDP growth, you wind up with the debt to GDP ratio stable and sustainable. So I think I'm not worried about the amount of government debt. I'm not worried about hyperinflation either. I'm more worried about deflation, which is what we're experiencing now, and which could exacerbate the nature of the financial crisis, much as what happened during the Great Depression and also what happened in Japan, your home country, during the 1990s.
Could you talk more about deflation and put it in the context of the stimulus packages in China and other countries, which seem to be contributing to more overcapacity?
Well, in China, to the government's credit, they have offset the massive loss of export revenue by having a big fiscal stimulus. And it has entailed forcing the state-run banks to massively increase the amount of lending that takes place. And if you think that China is not a socialist country, I'd say think again. The government really does call the shots, and most of the enterprise is still partially state-controlled. So it's not a free market system, but in fairness, there are some benefits to that. The government can move quickly. The Chinese have the same problem we do, which is deflation. A year ago, the Chinese government was cracking down on credit expansion because they were worried about an overheating economy and too much inflation. Now, they're experiencing deflation, as are we, as is Japan, as is Western Europe. The problem with deflation is it increases the real value of debts and exacerbates the financial crisis. It means that you can't have, you have fairly high real interest rates at a time when you want negative real interest rates to encourage people to borrow. So the Chinese are doing the right thing. They're massively expanding their money supply. They're massively expanding government spending. I was just in Shanghai about 3 weeks ago, and I saw construction just about everywhere. And one of my Deloitte colleagues said, "Oh yeah, that's the stimulus money." And I thought, boy, we're spending a lot of money here. I don't see anything going on, so that they do get things moving a little bit more quickly than we do. But I think they're doing the right thing, and the bottom line is China will not have a recession this year, and their economy will likely accelerate pretty quickly, and along with the US, lead the world out of recession.
So you don't think that the increase in loans to enterprises in China is exacerbating the deflation by increasing their output when demand is weak?
No, you want to increase output. You want to increase the demand for goods. The interesting thing in China is that although there's been a massive drop in demand for exports from the US, which is appropriate given that we've overspent, that is being offset by fairly strong domestic demand in China. Retail sales in China are now growing at an annual rate of about 15%, which is astounding. So the Chinese economy is actually managing the transition, and I think it's a long-term transition, away from growth principally based on exports, more toward growth based on domestic demand. And boosting demand is the way to deal with the deflationary pressures, which is good.
So how can that happen when thousands of factories have been closed and millions of people have lost their jobs?
Well, it's true. Tens of thousands of factories have shut down. The Chinese government itself reports that 20 million migrant workers who work in the coastal cities and big factories have lost their jobs. It's estimated that about 10 million of those people have returned to their ancestral villages. So there's been a reversal of a long-term migration into the big cities. And part of that reversal, as was mentioned earlier, is government policy to push some of that manufacturing capacity into the interior. But most of those people who lost their jobs were relatively low-paid workers. On the other hand, a fairly disproportionate share of, say, consumer spending in China is accounted for by more middle-class people who live in big coastal cities like Shanghai and Beijing, who are not involved in the export sector, and they haven't lost their jobs. They have a sizable stockpile of savings. They haven't lost their confidence, and they continue to spend. And their part of the economy is being stimulated by the government fiscal plan.
So it sounds actually like the solution to this economic recession has already been found. How long do you think it'll take before growth picks up? Or am I being over-optimistic here?
Well, growth will pick up. I mean, again, we haven't lost our productive capacity. We've just simply lost our confidence to a large extent. But there are some positive signs now. Here in the US, we're on the verge of seeing a big increase in government spending. It hasn't really happened yet. We've had a massive increase in liquidity on the part of the Federal Reserve. The credit markets are starting slowly to repair. We've seen credit spreads start to decline. The price of credit default swaps has declined. That's an indicator that credit markets are starting to function more normally, although not enough yet. The low interest rates have encouraged millions of people to refinance their mortgages, although unlike in the past, there's no extra cash that they can cash out of their homes, but they're getting lower payments as a result. The decline in home prices has encouraged more spending on housing. We're seeing a pickup in activity in the housing market as a result of that. And in the first quarter of this year, a large part of the decline in GDP was a reduction in inventories, which means businesses have cleared up their inventory backlog, and they're now in a better position to start increasing production and increasing inventories. So my expectation is that the US economy will start to grow again by the end of this year. The Chinese economy, which is not in recession, which is just in a slowdown, will probably accelerate by the end of this year. So the US and China together will, I think, lead the world into recovery. Other parts of the world, like Japan and Western Europe, which are in deeper and more difficult recessions will take longer to recover, but they will be stimulated by what happens here in the US and China. Now, that's my prediction with the caveat that a lot could go wrong. It's it's the one hand on the other hand kind of thing. And I think the biggest thing that could go wrong is we don't really know if the Obama plan to clean up the banks is going to work. It's only just beginning. We're in new territory. We don't know the degree to which the banks will be willing to sell toxic assets to private investors. We don't know the degree to which, when they do that, that will encourage private investors to recapitalize the banks. We could have a situation where the banks are very profitable. They now are profitable, but where they don't actually do very much, in which case you have sort of zombie banks, and you wind up with an L-shaped recovery, which again is what happened in Japan in the 1990s. The economy dropped, and then it just didn't grow for about a decade. I don't think that's going to happen here, but I do think it's cause for concern.
Well, what about the balance of the global economy? Look, the European economy is bigger than the North American economy, and the Japanese economy is considerably larger than the Chinese economy. In Japan, their export engine has just died, right, and consumer spending in Japan is likely to go nowhere for a long time. In Europe, well, I'd like to hear your comments on this, that there seems to be a great deal of uncertainty over the state of the European banking system, and it also appears that disclosure there is not what it should be, particularly on the continent. We get a lot of lectures about hedge funds and not enough information about the banking system there. What do you think of that?
Well, first of all, I think hedge funds get a bad name because they really had very little to do with this crisis. But first, Europe. Europe is in a much deeper recession than anybody expected. Part of the problem is that, well, the IMF now estimates that there are $4 trillion worth of bad assets. Of that, about $2.5 trillion were originated here in the US, but 40% of those assets were held by European banks. So that's one of the reasons that the credit crunch has extended to Europe. Moreover, a couple of European countries, the UK, Spain, Ireland, some of the countries of Central Europe, had characteristics similar to the US in that they borrowed too much, they had housing price bubbles. In the UK, consumer debt as a share of income is higher than it is here in the US. So they've had some of the same unwinding of imbalances that we have had here. And then if you look at a big economy like Germany, they were dependent on exporting to those countries that borrowed, like the US, like the UK and Spain. And since those countries are now unwinding their imbalances and deleveraging, they're not importing as much from Germany, and so Germany is in a deep recession. So overall, Europe is in a deep recession. Their governments are not responding adequately in terms of fiscal stimulus, in my opinion. And only in the past week did the European Central Bank decide to engage in the kind of quantitative easing that we're seeing the Fed and the Bank of England undertake. So the Europeans have been slow to do what needs to be done to offset what's happening. I do think they'll recover ultimately, but it will take a little bit longer, and it will wind up having been a deeper recession than anybody had expected. Japan is in an export-led recession. In the first quarter, GDP declined at an annual rate of 15%, which is, I think, the worst ever, at least in recorded history. On the other hand, it's still a very rich country, and people seem to be quite comfortable. So it's kind of an anomaly. I don't think the Japanese government has done what needs to be done in terms of policy offset. So Japan, too, will depend on renewed demand in the US and China for a revival of its growth, and it might take some time before that takes place.
Let's go back to Europe for a second. There's a problem with the Eastern Europeans having borrowed way too much money in euros, which they can't pay back now. Right. The estimates of the size of that problem vary considerably. What's your view of this?
Well, that is a big problem. Countries like Hungary, the Baltics, Iceland. Iceland was just one giant hedge fund, basically. These economies did borrow heavily in euros and in Swiss francs on the expectation that they would quickly enter the Eurozone, and therefore it really wouldn't be any currency risk. But that hasn't happened. In the meantime, the demand for their exports has shriveled, and their access to global credit markets has shriveled because of the global credit crunch. So suddenly these economies can't pay their debts, and big European banks are heavily exposed to those economies. So that has exacerbated the credit crunch in Europe unrelated to the US subprime mortgage market. That just adds fuel to the fire, but again, at the end of the day, it will be a mixture of policy offset and strong demand from the US that will bring Europe overall out of recession.
Okay, so a year from now, things are improving gradually. If we look out even further, 2 years, 3 years out, how different is the world economy going to be from what it was, say, a year ago?
Well, I think we're kind of at an inflection point, excuse me, in that in the past decade, we've had a huge imbalance in the global economy, where the US grew principally by consumer spending and Asia grew by exporting. And the US took on a lot of debt to fuel that consumer spending. In fact, during the past decade, millions of Americans refinanced their mortgages and took advantage of the increasing house prices to cash out some of the extra equity in their homes. And that extra cash accounted for about half of the growth of consumer spending in the US. Another way to look at it is in 2006, that extra cash was about $700 billion, whereas last year, Americans cashed out only $20 billion out of their homes. This year will probably be nothing. So we can't go on the way we did, obviously. So we're at an inflection point where, going forward, the US will see slower growth of consumer spending, and consumer spending become a smaller share of GDP as Americans rebuild their savings. And more of our growth will come from exports and business investment and government spending, too, particularly on healthcare. Whereas Asia will move in the opposite direction. If you look at the US, 72% of GDP is consumer spending. In China, consumer spending is only 36% of GDP. It's an abnormally low number, which is destined to rise. And I think if China continues on the path it's on, we'll see a slowdown in the growth of exports. Exports themselves will shift toward more higher value-added products, away from the low value-added products they rely on heavily now. And more of their growth will come from domestic demand, particularly consumer spending. So there will be this rebalancing of the global economy, and that will create some new opportunities and some new challenges as well.
Well, the East Asians, are they going to get over their addiction to exports? What you're saying implies that the value of the dollar is going to go down?
Yes.
And that the international monetary system is going to change?
Well, I think for China, the transition is not that difficult because it's a huge market and domestic demand still accounts for the lion's share of the economy. And they're already in the process of making that transition. They will still be sizable exporters. It's just that exports will grow more slowly than they have in the past. I think the real challenge will be for some of the other East Asian countries that have supplied inputs to the Chinese economy. Countries like Taiwan and Korea and Singapore and Malaysia and so on. These economies have, in recent years, become very dependent on exporting commodities and inputs into the Chinese supply chain, which were then reprocessed into exports to be sold in the US and Europe. Those economies are now suffering the most. They've seen huge drops in industrial production and GDP, and for them, making that transition will be more difficult. I think they will likely continue to export a lot to the Chinese market, but they will export products that will flow into Chinese domestic demand rather than into the export pipeline.
We haven't talked about India or Russia yet. Do you have some comments on those two countries?
India, first of all, has the very good fortune this past week of having re-elected a very good government, led by a prime minister who's a very good economist, which is close to my heart. And now that he has a much larger position in the parliament, he will likely be able to enact some of the reforms that he wasn't able to do in the past 5 years. So I'm optimistic about India. India is slowing down this year, not in a recession, in part because their economy is not as exposed to the global economy as some other countries, and I think they'll recover quickly. I'm not sure, on the other hand, that India can sustain the kind of growth they had in the past 3 years, 9 or 10% growth. Given India's infrastructure, given some of the regulatory obstacles to doing business there, I think a more reasonable expectation would be growth of 6 to 7% per year, which is still strong, but it's not like Chinese growth. India can reach that higher level if this government is successful in implementing some reforms, but that will take time. So I'm cautiously optimistic about India, and I think India is going to become a much more important hub for manufacturing, particularly as China moves up the value chain, as their currency and their wages rise. A lot of the capacity to produce low value-added products along the Chinese coast will either move to the Chinese interior, which is already happening, or some of that will move to India. India is already a very significant manufacturer and very skilled at manufacturing, and I think that will become a much more important part of India's economic growth.
And Russia?
Russia is an economy that has basically grown on the basis of high oil prices. And now that oil prices have come down, they're not growing. They're in a deep recession. And their government has not respected private property rights, not been welcoming to foreign investment in their resource sector. And as a result, oil production last year actually declined, even though the price of oil was the highest it had ever been. So they have some problems. That being said, I think when the global economy recovers, the price of oil and other commodities is likely to rise again, possibly substantially, and that will be beneficial to Russia. So Russia, I think, will resume relatively strong economic growth, and if you're involved in non-resource industries in Russia, then the government basically leaves you alone. So there are some positive elements of the Russian story.
So we'll come back to the United States and see a smaller role for the United States in the global economy, more dependence on exports or dependence on the growth of other economies, presumably a cheaper dollar and higher oil prices. What does that add up to?
Well, it adds up to where we were just a few years ago, basically. I mean, we'll get back to normal growth. We will have higher commodity prices, but that's not necessarily a bad thing. I mean, if Obama is not successful in getting a cap-and-trade system, and it's not clear he will be successful, then the other way to deal with climate change is to have very high oil prices, because that would encourage conservation, and it would also encourage investment in new technologies that would enable greater efficiency and alternative sources of energy. And of course, that will be very important if we expect countries like China and India to achieve middle-class affluence. They will not be able to achieve it using the current mix of energy and other commodities, because if they demand energy at the rate they're now using it, oil prices will go through the roof. And if they do, then there will be investment in new technology. So the future will be a different kind of future if we have very high oil prices. We'll have a different mix of technologies for generating energy.
Japanese corporations are right now in the middle of a massive shift in emphasis from IT and semiconductors and other electronics to technologies related to energy and the environment. Can the shift in technology and the development of technology alone be a major growth driver to get us out of the recession?
Not necessarily to get us out of the recession, but I think it will be a significant growth driver in the future. We've had, in the past 30 years, a huge change in technology. The whole development of information technology led to sort of a second industrial revolution that led to an acceleration of the growth in the global economy. Well, that investment in technology combined with globalization, combined with the entry of 2 billion consumers into the global market, led to higher growth. I think in the future we'll get that higher growth with continued investment in information technology, but also new investment in other types of technology, energy technology and biotechnologies in particular. The challenge for us here in the US will be to be at the leading edge of that investment so that we can maintain our position as having the higher standard of living in the world. And that will require investment in human capital and education, government investment in basic research, which is now accelerating, which is good, and also immigration. If you look at the rich countries in the world that have had the strongest growth in the past decade, those have been the countries that have been most welcoming of immigrants, like the UK, Ireland, Canada, Australia, and the US to a certain extent. And if we stop that, I think we'll have a problem in terms of our leading edge position in technology and therefore economic growth.
So the immigration into the United States has already dropped substantially because the number of jobs here is down. And if the really exciting economic opportunities are going to be in China or India, who's going to come here? How do you stimulate the immigration of skilled people in that kind of situation?
Well, it's a challenge. Well, I think once our economy starts to grow again, people will want to come here. I'm not concerned about immigrants wanting to go to China rather than the U.S. That's not likely to happen. The challenge for us is to, the economic argument for immigration is a strong one. The social argument is more difficult. The political argument is more difficult. We made a big mistake after 9/11 in reducing the number of H-1B visas. And that led to technology companies opening more research facilities in India rather than doing it here because we're not producing enough engineers and we need to import them. The evidence suggests that when you bring in skilled people, they start businesses and they create jobs. A very significant share of the entrepreneurial businesses in Silicon Valley were started by immigrants. So there will be no difficulty in attracting people. It's a question of whether we actually let them in. That's a political question. And at a time of economic stress, it's hard to make the argument to increase immigration. But once the economy recovers, it's an easier argument to make, I think.
Okay, well, thank you. We have 2 or 3 minutes left, so if anyone has any questions, please raise your hand in the back.
Sam just got her exercise for the morning. This is Craig Norris with the Tensity Group. Turning attention to the U.S. for just a moment, it appears that the major strategy followed by at least the larger companies in this economic tough time is let's shed people. In fact, Mark Hurd's company, he was here yesterday, just announced another 2% layoff, in spite of the fact that he announced yesterday that they met their numbers and are doing quite well. Could you comment on that?
Sure. Generally, historically, employment tends to lag the economy. So even when we start to see economic recovery, we may continue to see increases in unemployment for a while before we start to see job creation. Job creation is the last thing that businesses decide to do once they see a revival in their sales. So unfortunately, we are continuing to see job losses, and that will probably persist for the rest of this year, and we may see a fairly high unemployment rate. That's unfortunate. The good news is that that will be reversed ultimately when the economy starts to recover.
Anyone else?
I'll just shout. You mentioned that the success of countries which have allowed immigration. I would think that a very large exception to that, though, would be Iceland, which has not had any immigrants, as far as I know, or a very small number, even in relation to its very small population. Is that therefore a useful? Does that do any damage to that as a useful indicator?
Well, I think Iceland's growth was built on a pyramid scheme almost. I mean, they didn't really increase their productivity or their production. They borrowed to expand their standard of living, and they're now paying a huge price for that. So I'm not sure Iceland is a good example of a country that experienced sustainable economic growth. But if you look at, and immigration obviously is not the only thing. There are obviously examples of countries that have grown without immigration and vice versa. But on balance, immigration does benefit economic growth, especially for countries that have demographic problems. And we all do. We all have an aging population, a low birth rate. Immigration helps to deal with that because you get relatively younger people coming in and improving the demographic mix. But you also get more entrepreneurship as well. And we've seen that in those countries that have encouraged immigration. And of course, Scott lives in Japan, a country that doesn't have very much immigration at all. And I think that's had a negative effect on the growth of the Japanese economy.
Okay, thank you. We're out of time.
Okay.
And thanks very much.